Hey everyone, Thomas here. And in today's Tax Smart video, I'm going to answer a question from a member of the Tax Smart Investors Facebook group. If you're not already a member of the Tax Smart Investors Facebook group, you could join today by going to www.facebook.com/group/taxsmartinvestors or by clicking the link in the description below. That said, we do have a question, and that question is, if you're thinking of creating a parent company to own real estate assets, basically a holding company, would an LLC or an S corporation tax status be better? And generally speaking, an LLC taxes a disregarded entity, or as a partnership is going to be the most appropriate entity for a real estate holding company. This is because these types of entities are relatively flexible when it comes to removing properties from the LLCs if needed without triggering a taxable event. This could be important because at some point in the future, you may need to restructure your entities for some reason. Perhaps it's legal protection, asset protection. Maybe it's because you need to get financing and you need to remove a property from an entity, from an LLC to do that. Or maybe you're just doing some estate planning. There's a lot of reasons why it could occur. You might not even foresee the reason today. But if it does come up in the future, you're going to want that flexibility to remove the property from the entity without triggering a taxable event. However, if you're going to use an S corporation, when you remove a property from an S corporation, it's going to be treated as a sale at fair market value. And especially in markets like today, you're generally going to recognize a capital gain on the sale of a property at fair market value. And this is going to occur even if you're just trying to transfer the property from the S corporation that you may own 100% into your personal name or into another LLC you own at 100%. It does not matter whether you're doing that or you're selling it to a third party. You would trigger a taxable event. That's something you're going to want to avoid. And I've seen this come up a lot with clients. Sometimes clients have properties in S corporation for many years. I've seen this one client who had, I think, over $1 million capital gain, and they were simply trying to remove one of the properties they owned from the S corporation into another entity for financing purposes. And this large capital gain was preventing them from doing so. And it just didn't work out. And it becomes a really complex nightmare to try to figure out. You pay a lot of money in attorney fees, a lot of money in tax planning fees, just to try to get that property out. So having said all of that, as a general rule, you want to avoid holding rental properties in an S corporation and instead hold them in LLCs that are taxed as a disregarded entity or as a partnership, because again, you can remove them relatively easily without triggering a taxable event in many cases. Whereas with an S corporation, removing the property from the S corporation will trigger a taxable event because it will be treated as a sale at fair market value, even if you're taking the property out into your own name or into an entity you own. Hope that helps. And again, if you're not a member of the Tax Smart Investors community already on Facebook, go ahead and click the link in the description below. And who knows, we might just answer your question on the next episode of Tax Smart Investors.